Hi, and this is the guide I wish I had before I put money into the stock market. I'm going to be talking about goals, how much you can invest, your risk tolerance, your investing style, picking your broker, funding your account, picking your stocks, and the types of ways to buy and sell. But before we get into all of that, in case you're new to the channel, I'm Andrew, and this is my investment journey, where I like to talk about dividend-paying stocks, where you can invest in them to receive passive income and reach financial freedom. So if you like to earn while you sleep and you're on a journey to retire early, then hit that subscribe button. I'd love to stay connected as we grow our portfolios and collect that money. Speaking of which, investing in stocks is a powerful way to grow your wealth over time. This beginner's guide takes you through the essential steps to invest in stocks, whether you have thousands set aside or can invest a more modest $25 a week. Let's get started. Investing in stocks and letting your money work for you is one of the ways to grow your wealth. Investing involves a chance of losses. However, there are ways to lower your risk, though you can't eliminate it altogether. New investors have never had so many resources for expert advice. Following these steps, you'll learn how to set clear investment goals, choose the right stocks, and understand the basics of stock investing. Now, step 1 is set clear investment goals. Begin by specifying your financial objectives. Clear goals will guide your investment decisions and help you stay focused. Consider both short-term and long-term goals, as they will affect your investment strategy. You might have short-term goals like saving for a home or a vacation, or have long-term objectives like securing a comfortable retirement or funding a child's education. Your objectives depend on your life stage and ambitions. Younger investors tend to focus more on growth and long-term wealth accumulation, while those closer to retirement typically prefer generating income and capital preservation. The more precise you are, the better you will be. Don't use any vague goals like saving for retirement. Aim for specific targets like accumulating $500,000 in your retirement fund by age 50. Determining your investment time horizon is going to be how you assess how long you have to achieve each goal. Longer time horizons often allow for more aggressive investment strategies, while shorter ones require more conservative approaches. The longer you give yourself, the less conservative you'll need to be early on. Evaluating your finances. You need to be realistic on how much you can put away towards your investment goals, considering your savings, regular income, and any other financial resources that you have. Ranking your goals. Most of us balance several goals at once, and we have to prioritize saving for a home down payment, paying for a wedding next year, or preparing for retirement based on our urgencies and how important it is. For example, saving for a down payment on a house might take precedence over planning on a vacation. Adapt as life changes. It's an ongoing process that should evolve with your needs and wants. You might fall in or out of love, have many children or none at all, or realize that your life's work means crossing across the country. Regularly review and adjust your goals as your life changes. The first step is always the biggest, but by setting clear and precise investment goals, you'll lay a strong foundation for building your investments. This clarity will help you navigate the stock market with confidence and purpose. The second step is determining how much you can afford to invest. Pinpointing how much you can afford to put into stocks requires a clear-eyed assessment of your finances. This step helps ensure that you are investing responsibly without endangering your financial stability. Reviewing your income sources. Begin by listing all your resources. Check if your employer offers investment options with tax benefits or matching funds to amplify your investments. Establishing an emergency fund. Ensure you have a solid financial foundation before investing. Solid does not mean perfect. Now, this fund should cover a few months' worth of major expenses, such as mortgage or rent payments and other essential bills. Pay off high-interest debts. Financial planners typically recommend paying down high-interest debts, such as credit card balances. The returns from investing in stocks are unlikely to outweigh the costs of high-interest accumulations on these debts, thus scrutinizing each of your debts, similarly weighing the investment payments against potential investment returns. Likely, your debts will come first. Create a budget based on your financial assessment. Decide how much money you can afford investing in stocks. You also want to know if you're starting with a lump sum or small amounts put in over time. Your budget should ensure that you are not dipping into the funds you need for expenses. Don't worry if your funds are less than you would wish. You wouldn't kick yourself for not being ready for a race on your first day of training. So too it is with investing. This is a marathon, not a sprint, and the journey is still ahead. 2 points to remember. Only invest money you can afford to lose, and never put yourself in a vulnerable position for the sake of investing. Take this seriously. It is what separates investing from gambling. Now, step 3, finding out your risk tolerance. Understanding your risk tolerance is a cornerstone of investing. It helps you align your comfort level with the inherent uncertainty of the stock market and your financial goals. Self-assessment. This is where you reflect on your comfort level with the ups and downs of the stock market. Are you willing to accept higher risks for potentially greater returns, or do you prefer stability, even if that means potentially less in the end? Consider your time horizon. Your risk tolerance often depends on your investment timeline. Longer horizons allow for more risk since you have time to recover from potential losses. Shorter timelines typically require more conservative investing. Gauge your financial cushion. Assess your finances, including your savings, emergency fund, and other investments. A solid financial cushion can help you take on more risk. Align investments with risk levels. Choose stocks and other investments that align with your risk tolerance. Some examples for a low risk are dividend stocks and bonds. Moderate risk would be a mid-cap to large-cap stocks, index funds, and exchange-traded funds. And a high risk would be small-cap stocks, growth stocks, and sector-specific investments. Adjust over time. Your risk tolerance may change as your finances and goals evolve. Regularly reassess your risk tolerance and adjust your investment strategy accordingly. By accurately determining your risk tolerance, you can build a portfolio that reflects your financial goals and personal comfort level, helping you navigate the stock market with more peace of mind. Step 4, Determining your investment style. Your investment style is crucial in how you approach stock investing. Whether you prefer a hands-on approach or a more passive strategy, understanding your style helps you choose the right investment methods and tools. Everyone has a different relationship with money. Some prefer an active role, meticulously poring over every last cell in their portfolio spreadsheets, while others opt for a set it and forget it approach. They trust their investments will grow over time if they just leave it alone. For the DIY investor, there's two main approaches: the passive, set it and forget it approach, or the active, trial and play. For the passive, set and forget, you use your brokerage account to automatically purchase shares in the stocks, ETFs, and mutual funds you select. Although you control which investments you buy, your brokerage account handles the transactions on the specified day and for the amounts you decide. This approach also involves dollar cost averaging, where you set up the purchases and then let the system handle them for you, allowing you to invest consistently without needing to actively manage each transaction. For an active one, you use your brokerage account to access various investments, including stocks, bonds, and other assets, and trade as you wish. You'll set your goals and then choose when to buy and sell. Professional guidance. For those who prefer a more hands-off approach and want a more experienced broker or financial advisor, is often invaluable. These financial professionals tailor their advice to your life experiences and goals, help you decide among the most promising stock choices, monitor your portfolio, and collaborate with you when things need changing. Step 5. Choose an investment account. You've figured out your goals, the risk you can tolerate, and how active an investor you want to be. Now it's time to choose the type of account you'll use. Each has its own features, benefits, and drawbacks. In addition, the type of account you choose can greatly impact your tax situation, investment options, and overall strategy. You'll need to compare different brokers to find the investment account right for you. Evaluate your investment goals, which is matching up your investment account type with your goals. Scrutinizing account fees, commissions. Trading commissions are fees brokerages charge when you buy or sell securities. Some brokers now offer free trades for particular investments. And then you have subscription-based fees, which instead of paying per transaction or for a specific service, you pay a flat monthly or annual fee for your subscription, which may include commission-free trades, access to research tools, and other premium support. Check for added features. Some accounts offer additional features such as automatic contributions, access to financial advisors, educational resources, and more. Select an account that provides the features that fit your investment strategy. Research and analysis will help you choose a broker with robust research tools, market analysis, and educational resources to help you make informed decisions. User-friendly trading platform shouldn't be glitchy or too difficult for you to use. It's best if it has real-time quotes, sophisticated charting tools, and mobile access. Customer service. Look for brokers that offer several customer support options, including phone, email, live chat, and in-person support if needed. Reputation and security. Avoid any platform that is not regulated by authorities like the New Zealand Financial Market Authority, the MFA, or the US Securities and Exchange Commission. Also check that the broker's employs strong security measures, such as encryption and two-factor authentication, to protect your personal and financial information. Picking your broker. Now, there are a lot of different brokers out there. Preferably, you're going to want one that's in the country you're living in. There are 3 different types of accounts that brokers have. Standard brokerage account, sometimes called a taxable brokerage account or a non-retirement account. Provides access to a broad range of investments, including stocks, mutual funds, bonds, exchange-traded funds, and more. Any interest or dividends you earn on investments, as well as any gains on investments that you sell, could be subject to tax in the year that the money is received. Then you have retirement accounts. And a retirement account is basically KiwiSaver or a 401k. And the third account is an investment account for kids. Now, that investment account requires that the owner be at least 18 years old. A parent or guardian in New Zealand can open a retirement account, a KiwiSaver, or a kid's standard account linked to their account. Now, by the end of this step, you will have picked a broker that aligns with your investment goals and preferences, or is simply the most convenient. Once you've chosen a brokerage account and the type, you'll open your account. This involves providing your personal information, such as your IRD number for New Zealand or social security number for the US, your address and other such details. 6. Fund your account. A bank transfer, the most common method is to transfer funds directly from your bank account. This can be done via electronic funds transfer or wire transfer. Transfer from another brokerage. If you have an existing brokerage account, you can transfer assets directly across from your old account to your new account. And the last one is setting up automatic contributions, which ties into your set and forget. Step 7. Pick your stocks. Even experienced investors grapple with choosing the best stocks. Beginners should look for stability, a strong track record, and the potential for steady growth. Resist the temptation to gamble on riskier stocks, hoping for a quick windfall. Long-term investing is mostly slow and steady, not fast and rash. Here are the types of stocks more likely to be solid bets when starting off. Blue chips. These are shares of large, well-established and financially sound companies with a history of reliable performance. Examples include companies listed in the Dow Jones or the S&P 500. They are typically industry leaders and offer stability during market fluctuations. Think of Microsoft, Johnson & Johnson, Visa. These are blue chip companies. Dividend stocks. Companies that regularly pay dividends can be a good choice for beginners. Dividends give you a reliable income, which can be reinvested to buy even more stock. Growth stocks, the greater the chances for outsized growth in a stock, the riskier investing in it will be. Beginners investing in growth stocks should target industries with long-term potential, such as technology or healthcare. Defensive stocks, these are industries that tend to do well even during economic downturns, such as utilities, healthcare, and consumer goods. They will give you a buffer against market volatility as you start. ETFs, while they're traded like stocks, these track market indexes like the S&P 500 and offer instant diversification, reducing the risk associated with individual stocks. As you gain experience, you can look at funds with sectors that pique your interest and meet your investment goals, environmental and social. It's prudent to begin with a conservative approach, focusing on stocks or funds that offer stability and a good track record. This will give you confidence as you advance in your investing journey. Step 8, how to buy and sell. Now, you'd think this would be easy, but there are a lot of different ways in which you can do it. So, a market order is when the market is open and there are shares available, your order will be placed immediately. A limit order is when you're given more control to buy or sell shares at a specific price or better. A limit buy order lets you set the maximum price you're willing to pay per share, and a limit sell order lets you set the minimum price you want to sell your share. When investing in the US share market, you can't place a limit order for a fractional number of shares. Only whole shares can be purchased when placing a limit order. Stop loss and trigger buy orders. So a stop loss and a trigger buy orders gives you more control over the price at which you buy or sell. Congratulations! You just finished the Guide to Investing Level 1 and started your investment journey. If you have any questions, queries, problems, theories, put them in the comments below. I'd love to hear what investment platform you chose and the first stock you bought. Leave a like and subscribe if this content helped you out.